Swayam Prabha. Digital India. Educated India.
Welcome dear students. Today we discuss financial institutions and their working. I am Dr. Jaswant Saini, Associate Professor, Faculty of Law, MD, University Rohtak, present this topic before you. This is the very important topic to develop your understanding about the financial institutions. As usual, we start with the learning outcomes. Very first learning outcome of this discussion here, to understand the role of financial institution in strengthening the Indian economy. Second one, to recognize their role in mobilizing savings and allocating them to productive ventures and activities. Third one, to learn about different types of financial institution and their working in the country. And fourth and important outcome is here to understand the role of financial institution in urban and rural developments. Both type of developments we discuss in this discussion, urban development as well as rural development. And financial institutions play very important role in this direction. When we talking about the productive ventures or the activities where we required the money, these money provided by financial institutions. Introduction of this financial institution we start with, they are the business organization. Financial institutions are business organization serving as a link between savers and investors, and so help in the credit allocation process. Money in the hands of those who save the money, and money required to whom who apply their money in the productive ventures. Basically money required to the industries and money in the hands of investors. So financial institution play an important role as a link between investors and the industries, and that activity is known as credit allocation process. Financial institutions sometimes deemed to be organization, sometimes considered as establishment. Sometimes they define as the organization and that focuses on dealing with financial transactions such as investments, loans and deposit. Financial institutions play different role in different scenario. But basically they pool the money, they collect the money for the purpose of industries, and they provide this money to the industries. And industries, this huge money apply in the productive ventures or the productive activities. And financial institutions play the role of link. They play the role of link. They play the role of bridge between investors and industry. And another important function they serve, they mobilize saving habit among the investors. They provide the habit, they inculcate the habits among the investors who save the money in their own hands. So they mobilize savings of the surplus units and allocate them in productive activities, ensuring a better rate of return. That is the main object of every investors. When they invest their money, they invest with the intention to that earn more money. If their rate of return very high, they never hesitate to apply their money in such ventures. So mobilization of saving activity is the foremost activity of the financial institution, and financial institution play very important role in this direction. And financial institution is an organization. So I already clear before you, sometimes they treated as establishment, sometimes they treated as organization, which are incorporated for different purposes. Some of them may be profit making and some of them may be public social utility, public service also. So that's known as non-profit making. So institutions play different role in different scenario, and purpose of establishment of this institution play an vital role in case of functioning of these institutions. They accept the money from stakeholders and placing in any variety of investments vehicles for the benefit of both stakeholders and organization. So you remember one thing, they act in the direction of benefit. So they are designed to be earn more money for the benefit of stakeholders and for benefit of themselves also, means organization. Salient feature of financial institutions, that the various features, and one of them is here, it is an institution as well as intermediaries. So this word is the very important in this direction, who define they act as intermediary, and intermediary and link both are the same thing. In between investors and industry they act as link, and for the purpose of SEBI Act they are known as intermediaries. So financial institutions are the organization, they establish for some specific purpose, and the feature is here, they act as intermediary. So for your knowledge point of view, you remember one thing here, under section 12 of SEBI Act 1992, you need to be first obtain the license from SEBI to act as an intermediary. Without obtaining the license, you are not supposed to be act as an intermediary. Second and important, they channelize saving funds into investment funds. Those savings they provided to whom? For the purpose of investment. So investment is the main object. They need to be provide the money with the return, with the interest, and for this particular purpose they if are more return from this investment, then they are in this position to provide to the stakeholders. They save the money, they invest the money to create financial assets such as deposits, loans, securities, etc. So financial institutions play important role as an organization, as an institution to collect the money and provide this money to the industries. And they are act in both capacities. Sometimes they are act banking functions, sometimes they act as non-banking institutions. From their establishment, from their regulations, from their own constitution, they decide either they perform the banking function, either they perform the non-banking functions. So their establishment clear it very well, they are banking institution or they are non-banking institution. So in this direction, financial institution may be organized or unorganized institution. So important differences here to develop our understanding about they are organized or unorganized. The minute difference is here, organized sector always under the control of some certain set rules and regulation, and some regulators are there who regulate their functioning. But unorganized sectors not deals by rules and regulation, they deals by their own setup, their own rules and regulation. So they are not governed by the government regulators. So the basic difference is here, organized means some certain set rules and regulations and some regulators are there. Unorganized means no any rule and regulation, the parties decide their own condition of the agreements. They are regulated by the government and regulatory authority. Generally or majority of the cases, the financial institutions regulated by government or the regulating authorities. Only few areas where they are categorized as unorganized financial institution, they deals as unorganized sector. but majority of the cases financial institutions cover under regulated setup which set by central government or the state government. So, they are known as organized sector. It accepts deposit as well as provide commercial loans and real estate loans and mortgage loans. So, various type of loans provided by these financial institutions, and these loans decide on the basis of the purpose of the institutions to whom they provide the loans. And basic idea behind this financial institution to collect the money and provide it to the productive ventures according to their object, according to their establishment intention. So, financial institutions keep money flowing through the economic activities among consumers, businesses and government. Financial institutions not even provide the money to the institutions or the industries, but sometimes they provide the money to the government also, and sometimes they help the consumers also. So, they play very important role, they act as a link, they act as a productive important tool who provide money to the productive ventures. So, importance of financial institution is our financial system. Very first they provide the funds. Financial institution provide funds for the investment and industrial activities, not for any other purpose. They only provide the funds for industrial activities, not for any other activities. If you apply your money in the industrial activities, there may be chance to earn more money. So, that is a productive area, that is a productive venture. If you provide your money to buy the fixed asset, that's maybe not earn the money. If the articles you purchase for your own consumption, there is no any chance to earn the money. But if you purchase the article for resale purpose, there may be chance to earn the more money. So, various purposes here defined. The financial institutions basically set up to provide loans for various purposes for the industries. So, infrastructure facilities, financial institutions also offer basic infrastructure facilities needed for the development and promotion of profitable ventures. For example, here nowadays present central government established lot of projects of highways in entire India, and these highways established for to develop the infrastructure, and this infrastructure helpful for promotion for industrial activities or the activities related to productive ventures. So, development of backward areas. Apart from the financial activities, financial institutions also take care the development of such areas which are not noted by the other institutions. So, they take care the society also, and some responsibilities of developing the backward areas at free of cost by offering credit facilities, free education, employment and creation, etc. So, lot of functions performed by the financial institution, and some of the functions also related to the society, and they also helpful to develop the backward areas of any state or the entire country. And very set example in this direction, pharmaceutical industries established in Baddi of Himachal. So, this area is considered as backward area before establishment of these industries, and this industry promote by the pharmaceutical sector, and the atmosphere very helpful for establishment of the such units which relates to pharmaceutical sector. And this financial institution who provide loan to establish the industry in the particular sector, they take the benefit of some government incentives or the government schemes. Plant development, financial institution initiate all plant developments. So, plant development very important to develop the entire setup. Our government is also in this direction to develop the each and every area, because the society represented by each and every area, not a particular area. In view of economic growth of the state or economic growth of the country, that's depend on the plant development all plan developments are coordinated with the government plan and social welfare, and in this direction financial institutions play their important role. And accelerating industrialization. So, no doubt GDP of any country is the reflection that the government financial institution also helpful in plan development of any country or any economy. Financial institution initiate all planned developments in view of economic growth of the state. All planned developments are coordinated with government plan and social welfare. And institutions play their important role in this direction, and they also helpful in accelerating the industrialization. GDP of any country is the reflection of the growth of the economy, and industrialization play very important role in this direction. Development of agriculture sector is also play very important role, but the major role played by here of the industrialization. Financial institutions are helpful to establish the industries or the establishment to earn the profit and safeguard interest of the members. They accelerate the industrialization to contribute industrial growth. Where there is an industrial growth, it means that area, that state, that country automatically achieve the higher rate of GDP. And GDP no doubt reflection the lifestyle of the peoples of the particular country, and a country is considered as developed country only on the basis of the GDP or the life standard of the peoples. So, in this direction if the industrialization is there may be more chance to earn the profit, and in this direction financial institutions play their important role. They support industries by granting finance, project development and consultancy. They not only provide the finance, they also helpful to development of the particular area or the project or the unit, and they also provide the consultancy facility. They are expert in their field, no doubt they provide the finance, and as well as finance they provide some more other services also, and out of these services development and consultancy is the main important. So, that helpful very in this direction. Types of financial institution. Financial institution can be classified into two categories. One is known as banking financial institution, another is known as non-banking financial institutions. Only difference is here for the establishment. Banking financial institution established for banking activities, or they are involved in banking transactions, but non-banking financial institutions not perform directly the banking transactions, where the activities in the hands of banking institutions. So, banking industry is subject to the control of central bank, and in our India the RBI is the considered as central bank of bank. So, Reserve Bank of India is the apex institution who organizes, runs, supervise, regulate and develops the monetary system and financial system of the country. So, RBI is the bank of bank, and RBI is considered as the regulator of the same. So, money market regulator is RBI and capital market regulator is SEBI. So, where there is an coin and currency involved in any transaction, then RBI decide the policies, RBI frame the rules, and RBI issue time to time the master circulars for their functioning. So, Reserve Bank of India is the highest institution in India who regulate or govern the banking transactions or the banking institutions. So, the act who is responsible for establishment of this banking institution is known as Banking Regulation Act 1949. This act decide the statutory provisions to deals with the banks and banking transactions, and which type of institutions categorized as banking institution who obtain the license as per the rules and regulation defined in Banking Regulation Act 1949. The Indian banking institution can be broadly classified into two categories. The same applicable here, organized sector and unorganized sector. Organized sector means where there is rules and regulation and they are under the control of some regulators. Unorganized sector, here no any rules and regulation, and they are develop their relation on the basis of conditions settled by the parties. Parties are free to settle their condition here in unorganized sector, but in organized sector the rules and regulation framed by regulators, or ultimately they are under the control of central government or the state government. The organized banking sector consists of commercial banks, cooperative banks, agriculture banks and regional rural banks. So when we are talking about under this organized sector, how many areas cover? So first is here commercial banks, second cooperative banks, third agriculture bank, and fourth one is known as regional rural banks. They are the 4 units which cover under the heading of organized sector. In the organized banking sector, they are the indigenous bankers and money lenders at the local level who provide the money on the mortgage basis, who provide the money on some other basis as per the terms and conditions settled by the parties. These money lenders and indigenous bankers decide the condition. That area is unorganized sector. So non-banking financial institutions may be categorized broadly into 2 groups. One is organized non-banking financial institutions and second is unorganized non-banking financial institution. So the another 2 categories here for the non-banking financial institution, they are not directly involved with the public to accept the deposit from the public. So they are known as non-banking financial institutions. So development banks and financial institutions like IDBT, ICICI, State Finance Corporation, State Industrial Development Corporation and Agriculture Development Finance Institution like NABARD, they are known as organized non-banking financial institution. They are not directly involved with the public. They only provide the refinance facility or development facility in the particular sector. So the various here institutions who cover under this organized non-banking financial institution. The unorganized non-banking financial institutions include NBFCs, non-banking financing companies. They obtain the license under section 45I of RBI Act 1934. Before act as non-banking financial companies, you need to be first obtain the license from RBI under RBI Act under section 45I, providing whole range of financial services. Except the banking transaction, they provide the various services which known as financial services. So these include services, hire purchase services, consumer finance companies, leasing companies and housing financing companies, factoring companies, credit rating agencies, merchant banking companies, etc. So there is a huge list which established for these companies, which design for these companies, and various activities cover under this sector also. So factoring is the new word maybe for you dear students. Factoring means when we finance the financial transaction related to international business. So that is known as factoring companies who provides this particular facility to renowned institutions, renowned companies for development of their international relations. So financial authorities who set up to deal with the various areas, various segments, various sectors. The main component of any financial system is regulatory mechanism. In any economy, the financial system is regulated by the central banking authority of that country. In India, the central bank is known as Reserve Bank of India, and that is responsible to frame the rules, regulation and policies for this entire sector. So various type of financial authorities in India, they include CBDT, means Central Board of Direct taxes, that's deal with the all type of taxes covered by CBDT. All rules and regulation decided by CBDT. Central Board of Excise and Customs, also the one of the authority in this direction, and Reserve Bank of India is also responsible to frame the policies for these segments. Security and Exchange Board of India, that's the regulator of capital market, who deals with the stock exchanges and the company registrars, liquidators or the intermediaries. So, various activities now under the control of SEBI, which established in 1992 as a statutory body. So, Insurance Regulatory and Development Authority IRDA, that's related with the insurance companies. So, these are the regulators who deal the various segments, and in different segments they act as an policy maker, they act as the regulator who issue the direction time to time for the development. So, banking institutions are in the business of taking deposits from the public and making loans. So, they sometimes you know that PNB, SBI or other banks, they are known as commercial banks. They are perform the banking transactions and they are banking institutions and they accept the deposit from public and provide these deposits to the industry as a loan. And from the difference of return and accept the rate of interest, they charge their own expenses and the return to the stakeholders, and for the rest of the purposes they use this money. In addition, they provide other services such as investment, banking, foreign exchange and safe deposit lockers. So, various services nowadays provided by the commercial banks. They also provide the lockers, they also provide the net banking services, they also provide the consultancy services also. So, they also act as an portfolio manager in some extent. So, these institutions are regulated by government to protect consumers and ensure that the banking system is stable. And banking financial institutions are divided into three types. Very first is known as scheduled commercial banks, and second one is known as non-scheduled commercial banks, and third one known as scheduled cooperative banks. So, there are three type of banks here, and very popular in the general public, that is the commercial banks, and they obtain the license from SEBI to act as a banking transaction. And once you obtain the license from RBI, you are bound to follow the rules and regulation laid by RBI time to time. So, they are the banking institutions. Scheduled commercial banks, RBI grants a scheduled bank status to a financial institution only if they satisfy certain criteria as per the RBI Act 1934 and the Banking Regulation Act 1949. So, two acts are applicable on these institutions. One relate to license which given by RBI, and second relates to Regulation Act of 1949, Banking Regulation Act. So, scheduled banks are those mentioned in Schedule 2. So, which banks are scheduled bank? That is very clearly defined, which mentioned in the Schedule 2nd of the Reserve Bank of India Act 1934. No any other purpose. The schedule means only that they are in the list of Schedule 2nd of RBI Act. All the institutions who discharge the banking functions are under the control of RBI. So, being a regulator, RBI is the controller of these banks, and RBI frame the rules and regulation time to time as per the demand of the time. They amend the rules and regulation. Schedule 2nd and the rule making power in the hands of RBI. RBI when frame the rules for the banking institutions, they are supposed to be first consult with the central government before framing the rules, because central government is ultimate authority for responsibility owned on the behalf of entire institutions, either SEBI, either RBI, either CBDT. So, all institutions under the control of central government. So, central government is the ultimate authority, Central government is accountable towards general public. So each and every rules must first obtain the approval from central government. As per the rules, the bank's paid up capital and raised funds must be at least 5 lakh. So no doubt this amount is not a huge amount. So but as per the rules, every bank must maintain minimum this limit of amount of 5 lakhs. Scheduled banks are also member of clearing house facility. This facility provided by scheduled bank, and this is the important facility who certified that the transaction materialized between two banks, transactions settled between two institutions for this particular purpose, clearing house facility. For example, one check issued by SBI Bank and that accepted by Canara Bank. So they only materialize this transaction if the clearing house satisfy the transaction. If clearing house settled that all conditions are satisfied, then this transaction materialize. They are responsible for maintaining an average daily cash reserve ratio. This is the important aspect here. With the central bank, every bank must maintain daily basis cash reserve ratio. So cash reserve ratio means any time if any person demand the money from commercial banks, scheduled commercial banks, they never refuse if money indicate reflected in their account. So for this particular purpose, they need to be maintained some amount as a cash reserve ratio to satisfy the demand of their customers, to satisfy the demand of their consumers. On demand basis, when the money is available, that's due to the same cash reserve ratio with the central bank, they need to be maintained, and on the demand, on the requirement, a bank may be helped by the central bank. RBI also help to those banks on demand basis. The RBI permits scheduled banks to issue loans at bank rates. So that is also a important functions. Issue loans at bank rates. RBI permits. One bank may provide access money to other banks on demand. Now types of scheduled banks. Scheduled commercial public sector banks. There are the banks in which the government of India owns more than 50% of the stock. As a result, the government is the primary stakeholder in public sector banks. Where there is more than 50% shares in the hands of government, so these banks are known as government stakeholders banks, and these are the commercial public sector banks. Commercial banks are different thing, commercial public sector banks are different thing. So presently there are 12 public sector banks, but there are 27 banks that have now been merged in each other. You remember in 1969, former Prime Minister Indira Gandhi nationalized 14 banks and 6 another bank nationalized in 1980. There was a whose list of nationalized bank, but presently they are 12, and due to merger with each other, for example, State Bank of India, Bank of Baroda, including Vijay Bank and Dena Bank, Bank of India, Bank of Maharashtra, they merge. Canara Bank including Syndicate Bank, the Central Bank of India, Indian Bank including Allahabad Bank, Indian Overseas Bank, Punjab National Bank, etc. So presently public sector banks, commercialized public sector banks are 12. So scheduled private sector banks, these are the banks in which private entities have the dominant stake, major share in the hands of private sector. There are 21 private sector banks in total. All private sector banks provide their consumers with various banking and financial services. For example, here they are the Axis Bank, HDFC Bank, ICICI Bank, etc. It means 21 banks presently working in the private sector, and they obtain the license from the RBI as a scheduled commercial bank. So they play also very important role to accelerate the growth of country, to maintain the liquidity in the entire country. So scheduled foreign banks also working in our India in a huge number, presently 45 foreign banks are working. Foreign banks are international banks. They must abide by the rules and regulation of both the countries. So that's the responsibility on the part of these foreign banks. They follow the rules and regulation of both countries. One country where they incorporated or start their functioning or obtain the license, second country where they start their business. So there is a responsibility on the part of these foreign banks. They perform the rules and regulation of two countries. So they have several loan limits based on their capital structure. How much loan they provided, how much activities they also allowed to involve, that's depend on their capital structure. If they represent the huge capital, sometimes more facilities are available to them. If they have some minimized capital structure, then different type of restrictions are applicable, different type of riders involved by regulators on such banks. Now some scheduled payment banks also working in our Indian scenario, and Indian Post Payment Banks Limited, Fino Payment Bank Limited, Paytm Services Bank Limited and Airtel Payments Bank Limited are the scheduled payment banks in India. Paytm nowadays not perform well. RBI asked to this Paytm bank to stop their banking transactions, and the banking activities stopped by RBI because these Paytm bank not follow the KYC rule, and the rules and regulation which laid down by RBI, they are not strictly follow. So due to the same, RBI issued the direction to this Paytm bank to stop your activities related to payment system. So these institutions, once they obtain the license from RBI, they are bound to be follow the rules and regulation laid down by these regulators time to time. If they not follow, the RBI or the regulators take strict action against these institutions. They are always bound with the same. Now the regional rural bank, the government of India set up RRBs on October 2, 1975, and basic purpose behind this establishment of regional rural banks to promote these areas also, to provide these banking facilities, banking activities, banking transactions in rural side also. Development of India, not from the development of urban sector, development of rural sector is also involved in the development of entire country. The government of India set up this sector to strengthen this sector in 1975. These banks provide credit to the weaker section. They are established for special purpose, credit to the weaker section of the rural areas, particularly the small and marginal farmers, agricultural laborers, artisans and small entrepreneurs. So the purpose is here to promote this sector also, who play their role in the development of entire country, in development of these segments also. Weaker section, to promote weaker section is the major task, and marginal farmers, agriculture laborers, artisans and small entrepreneurs. These areas if develop, no doubt our rural area develop. Once a money in the hands of a people, the purchasing power increase. When money in the hands, purchasing power increase, the lifestyle, life standard of the peoples increase. That's how increase with the provide more and more facility in each and every sector. So along with urban sector, unless and until we provide the facility to rural sector, there is no any growth. We never claim the growth of entire country. Initially 5 RRBs were set up, which were sponsored by Syndicate Bank, State Bank of India, Punjab National Bank, United Commercial Bank and United Bank of India. Presently the number of RRBs stands at 43. Nowadays 43 regional rural banks are working in India to promote the various activities related to the rural sector, and they play very important role for the development of rural sector also. Non-scheduled commercial bank. Non-scheduled banks are those which are not listed in the second schedule of the RBI Act 1934. If they are listed in second schedule, they are scheduled commercial banks. If they are not listed in second schedule, they are known as non-scheduled commercial banks. They may not fully meet all the requirements outlined in clause 42, but bound to follow specific guideline as laid down by RBI. Either they are the scheduled commercial banks, either they are the non-scheduled commercial banks, they are bound to the follow rules and regulation laid down by RBI. It means both type of banks under the cover of RBI. Banks with a reserve capital of less than 5 lakh rupees. In earlier case, the limit is 5 lakh or more, but here 5 lakh or less than 5 lakh. That's the limit imposed by RBI on non-scheduled commercial banks, and they are qualified as non-scheduled banks. Unlike scheduled banks, they are not entitled to borrow from the RBI. Only difference is here, scheduled commercial banks on the demand obtain the loan from the RBI, but these banks not entitled to borrow from the RBI for normal banking purposes, but in emergency they are also allowed. RBI in emergency allowed to these banks also the facility of lending. Credit facilities also provided by RBI to these banks, but in exceptional circumstances, only in emergency. So, some of the examples here, non-scheduled commercial banks are here: Bangalore City Cooperative Bank Limited, Baroda City Cooperative Bank Limited. They are the example of these non-scheduled commercial banks. In emergency, the RBI take care these banks, but in general normal circumstances, RBI not take care of these banks. So, scheduled cooperative banks, that is another area. This is a financial entity that is owned and operated by its member who are both the owners and customers of the bank. So, basic feature or important thing or the very trigger thing is here, in this type of banks, the who operate, members operate. Who are the customer? Members are the customers. So, these banks other than members not allowed to accept the deposit. In India, UCBs are regulated and supervised by state registrar cooperative societies. Every state, their Cooperative Society Act is applicable, and state registrar of cooperative societies here responsible for such type of cooperative banks. In case of single state, cooperative banks are central registrar. If the unit relates to more than one state, then central government cooperative society registrar is the regulator of the same. If relates to only one state, then the concerned state registrar is responsible for the activity of these cooperative societies. So, multi-state cooperative societies also there, and state cooperative societies also there for run such type of banks. In 2020, all type of these banks and multi-state cooperatives banks were brought under the supervision of RBI. So, through this guideline which in 2020 inserted in statute books, they are under the direct control of RBI. Reserve Bank of India also regulates cooperative banks which are governed by the Banking Regulation Act 1949. That is the major act who deals with those institutions who involve in banking transaction, and banking laws. Cooperative Society Act 1955 is also applicable. According to the object of the institution, these acts are applicable. RBI Act is applicable, Banking Regulation Act 1949 applicable, Cooperative Society Act is applicable, or Company Act is also applicable. So, lot of corporate laws are applicable on these institutions that depend on their intention, their object, their memorandum of association or their establishment of unit. So, cooperative banks are the primary financiers of agriculture activities, small scale industries and self-employment. In rural areas, loans provided by these cooperative banks to the persons who reside in this particular rural area. They, if involved in activities, these activities addressed by these cooperative banks. Agriculture activities, small scale industries and self-employment. So, basically these activities happened in the rural areas and these banks address these activities. Cooperative banks operate on the principle of no profit, no loss. Basic purpose to establish these cooperative banks, no profit, no loss. It means they accept the money from the own members and they apply the loan to their own members. So, outsiders are generally not involved with the cooperative banks. And for this particular purpose, this principle is applied, no profit, no loss. This is the important task here, where you act in the social welfare activities. If there is no intention to earn the profit, it means you act very well in this direction for the benefit of this society, benefit of the entire country, benefit of the stakeholders. So, cooperative banks can further be divided into the following categories: urban cooperative banks and state cooperative banks. They are the two categories of cooperative banks. So, urban cooperative banks, the term urban cooperative banks refers to primary cooperative banks in urban and semi-urban areas. These banks primarily lend to small borrowers and businesses centered on communities, localities and workplace group. So, there are the three areas here mentioned where these urban cooperative banks provide loan facility. So, they provide basically to small borrowers. If the borrowers are industries, major industries or huge industries, these cooperative banks are not supposed to be provide loan facility to these industries. And businesses, which type of businesses? Which relates to communities or particular localities where these banks reside, or the workplace group. For these areas, they provide the lending facility. So, primarily finance entrepreneurs, small businesses, industries and self-employment in urban areas, as well as home purchases and educational loans provided by these banks. Urban cooperative banks contribute to community development. This community development is the major task on the part of every institution or every company or every government. By supporting local initiatives, participating in social welfare programs and providing financial literacy and education to the communities they serve. One of the example here, Mahindra Pride, that institution established for development of rural areas educational rate, literary rate. So, Educational Pride organize the workshop, 5 days workshop, 7-day workshop in the educational institution to promote these things. So, every company who earn the profit, they are bound under CSR funds to act for the society, to act for the community. Community development is the major task on the part of each and every government. Rural cooperative banks are financial institutions that operate at the initial level and are established to cater to the banking and credit needs of rural areas. It is made up of both short-term and long-term cooperative credit structures. It means rural cooperative banks provide for short-term as well as long-term cooperative credit structures. The short-term cooperative credit structure is divided into 3 levels: village level primary agriculture credit societies, district level, central level cooperative banks and state level state cooperative banks. So primary agriculture cooperative credit societies deals directly with the rural agriculture. Borrowers give them loans and collect repayment of loans given and also undertake distribution and marketing functions. So they play very important role. District level central cooperative banks and state cooperative banks are registered under the provision of State Cooperative Societies Act and regulated by the Reserve Bank as well as NABARD. If matter related to agriculture sector, no doubt NABARD is the supreme authority in this direction to deals with such activities. They primarily serve agriculture based activities such as farming, livestock, dairies, hatcheries and other related activities. They also give loans to small scale businesses. And in 1982, when NABARD established, all agriculture sector comes under the purview of NABARD. National Bank for Agriculture and Rural Development. These bank provide refinance facility to the institutions who provide loan for agriculture purpose or related to agriculture purpose. Rural cooperative banks have a great impact on the economic activities in rural areas. They built a great country for the entire purposes. When our rural area is strengthened, no doubt the entire country is strengthened, because majority of the people or the major population reside in rural areas. If their life standard increase, if their lifestyle increase, it means that's increase the GDP of the country, and we claim as a developed country. So non-banking financial institutions, they are the fast emerging as an important segment of Indian financial system. These are financial institutions that provide banking services without fulfilling the legal requirement as specified by RBI. If they follow the legal requirement of RBI relates to banking transaction, they are known as commercial banking activities. But if they not fulfill this one and involve in such activities, they are known as non-banking financial institutions. Non-banking financial institutions also mobilize financial resources directly or indirectly from the people. They lend the financial resources to establish and mobilize the liquidity in the market. Liquidity, if established in the market, it means market in the rightful direction. Liquidity indicates that when and where you require the money, you easily convert your financial assets into cash. So they are the three types of non-banking financial institution: development finance institution, investment institutions and non-banking financing companies. They are the development financial institutions. So they establish for particular purpose to develop the particular area. So in 1948, IFCI established for the development of industrial finance. So development financial institution, that's known as Industrial Financial Corporation of India, to provide the loan to the industries. And 1955 ICICI established. Nowadays ICICI not a development bank, he obtained the license of commercial bank from RBI. So IDBI established in the year of 1964 as a development bank, but IDBI also at present not act as a development bank. This bank is also act as a commercial bank. So in 1991, due to huge NPA on the recommendation of a committee, Narasimha committee, all development banks converted into commercial banks. Before 1991 they are development banks, but nowadays they are the commercial banks. So investment institutions also here, and in this direction LIC, GIC and mutual fund play the important role as an investment institution. They accept the money from the public and invest in the industries, securities. So Life Insurance Corporation established in 1956, and the huge money they apply in the security market, and they provide the loan facility to the industry. So that is the LIC is the government sector, and 50% of their accrual they apply in the security market as a loan. So, venture capitalists also here, non-banking financing companies are also here. So, some example here, Tata Capital Housing Finance, Sundaram Housing Finance and Hero FinCorp, etc. These are the example of non-banking financing companies who play very important role. So, refinance financial institution in this direction, NABARD who provide loan to the agriculture sectors, that is refinanced by NABARD, NHB that is housing finance, and SIDBI small scale industries. For this purpose they provide the loan, and National Housing Bank only provide loan refinance facility to those institutions who provide the housing loan to the public, and SIDBI also promote for small industries, that established in 1919. So, MSME is also supported by SIDBI, and Export Import Bank that is known as Exim Bank. Exim Bank established in 1982 for finance the international transactions, that provide the finance facility to those institutions who involve in international transactions. And now we are here summarize part, the summary of the entire discussion is here. Financial institutions act as intermediaries that establish the link between savers and investors, and they facilitating financial transaction. So, types of financial institutions are various, and we decide on the basis of their activities, in which direction they act. Non-banking financial institutions include development finance institution, investment institution and non-banking financing companies. Refinance institutions also supporting various sectors like agriculture sector, housing finance sector and financial assistance to credit institutions. These institutions offers diverse financial services and provide financial aid to new and existing businesses, including those in underdeveloped areas. Thank you.
Hello and welcome to this piece of literary snippet. We usually know William Shakespeare as the most revered figure in the history of English literature. But we often tend to forget that he has also been one of the most hated figures in literature. And here I am not talking only about those boys and girls who have to memorize long sections from Macbeth or King Lear or Julius Caesar before they can go and sit for their school or college exams. But I am also talking about people who are themselves quite famous authors. Tolstoy, for instance, considered the writings of Shakespeare to be, and I quote, crude, immoral, vulgar and senseless. George Bernard Shaw absolutely loathed Shakespeare, as he did Homer. But perhaps no other criticism about Shakespeare is more damaging than the one which says that Shakespeare is a marvelous storyteller, provided someone has told him the story earlier. Now, this piece of criticism is particularly damaging because it is true. None of Shakespeare's plays contain any original story whatsoever. They are all written using pre-existing materials, pre-existing stories. Now, does that diminish the stature of Shakespeare? as a dramatist? Well, I'll leave that for you to decide. See you in the next episode of Literary Snippets.